Welcome back. Let's look at the markets in Asia. They ended mixed this morning. China's stocks down slightly as Sino-US tensions have put a bit of a damper on hopes of an economic recovery. Hong Kong's Hang Seng 0.3% firmer, not much. In China, the Shanghai Composite Index a tad lower at 3,312, and the Nikkei in Japan are falling 1.2%. So that was the most significant drop. So the big data, jobs data in the US is coming out tomorrow when global markets are closed. That's unusual. That jobs data will guide the monetary policy of the central bank in the US, the Fed, further. Han Tan is the chief economist, chief market analyst rather, at Exinity, and he joins me now. Great to have you with us, Mr. Tan. What are you expecting in that jobs data tomorrow, and what could it possibly mean for the direction that the US Fed is on?
Right. So keep in mind we are operating in a bad news is good news type of environment, meaning to say if we see more weakening in the US jobs market, that could be good news for riskier assets such as US stocks, based on the idea that the Fed may be closer to being done with its rate hikes. And in fact, the markets are pricing in right now up to 50 basis points in cuts by the Fed in the fourth quarter of this year. I mean, having said that, now keep in mind that if this brings us closer to a US recession, then it isn't exactly going to be an all-out party, so to speak, in US stock markets.
So is it fair enough to say the good news is those interest rate hikes may end? We may even see rates coming down. The bad news is that may come along with a recession. So what does that mean for markets? Are we going to see them going up and down as these two issues dominate at different times?
Yeah, exactly. And look, this push and pull in market forces has been playing out really in recent months. So the idea is for investors to perhaps be more selective, i.e. if the prospects of a recession loom larger, then the safe havens such as gold should tend to benefit greater at the expense of riskier assets such as stocks and emerging market currencies, for example.
The recession fears, I mean, how big are those concerns? What is the probability of a US recession and then a global recession?
Yeah, so look, if the US sees a recession, the global economy is bound to take a hit, right? And although, to be fair, the global economy's hopes are very much pinned on China's recovery being sustained into the second half of this year. And to be fair, even the likes of the Eurozone appear to be handling things relatively better as well. So I think, with the prospects of a US recession, if you look at the bonds market, it is telling us that those fears are very real. But then at the same time, I think even the Fed themselves do not quite yet know whether or not the U.S. recession is a full-on reality. Yeah,
and on the other hand, we were talking about the possibility of rates coming down. That's actually good news for the likes of us in South Africa because we offer higher rates. Maybe a lot of investors will return to equities. What are you expecting over the next 2 weeks, say?
Yeah, well, and that's a very good point. Although keep in mind that while the spread between the rates, for example, could be higher, emerging markets as a whole tend to suffer or emerging market assets rather, tend to suffer when there are fears for a global recession, all right? Because, again, being the nature of emerging markets, perhaps the fiscal standing or the trade imbalances could feed into market fears that these emerging market economies may not be able to better withstand a recession. So once again, as you rightly pointed out, there is this push-pull dilemma when it comes to assessing investors' appetite for emerging market assets as well.
Yeah. Is it hard for your company, for many companies, to really hedge their bets? We're going into a long weekend, so the jobs data, I think this is quite unusual, that US jobs data, which is crucial for investors around the world, comes out on a Good Friday.
Yeah, and to be clear, I can't speak on behalf of my company's operations, but I think overall, when we look at investors and traders' sentiment, you just look at how S&P 500 is shaping up for today. The word I used in my client notes this morning was skittish. I think the S&P 500 U.S. stock markets as a whole appear to be perhaps reserving their full reaction to tomorrow's jobs data for next week. Granted, they had made some initial moves earlier this week based on some disappointing U.S. jobs data, and not the main one, but some other private payrolls, for example, or even the manufacturing sector in the U.S. that showed to be rather disappointing as well. So there have been some skittish moves, but I think we should see the larger, fuller reaction come Monday when U.S. markets reopen.
And finally, Mr. Tan, we've spoken about the broad fear of recession, the broad move perhaps to equities because of lower interest rates. But is there any granular detail you'll be looking for in the non-farm payroll data tomorrow? What does the U.S. jobs market look like? What has it been looking like over the last few months?
Yeah, a great point. So beyond the headline figure of about 250,000 jobs added, beyond the unemployment rate that's still hovering around those pre-pandemic lows around 3.6%, I think what markets and the Fed themselves will be paying closer attention to will be the wage growth, because as Fed Chair Jerome Powell has pointed out for several months now, that has been the sticky issue that's underpinning this stubborn inflation in the U.S., right? And that's giving reason for the Fed to persist with those rate hikes. So if we see higher than expected wage growth, average hourly earning wage growth in the U.S., despite a lower headline number or despite an uptick in unemployment, I think that will feed into the Fed's inflation battle, and that could imply more rate hikes rather than less, given what markets are predicting right now.